So the headline, obviously, that China's going to roll back some of these trade tariffs for some of these products, et cetera. When you come in and look at that as a trader, what do you think of it, Vince?
I think people are maybe blowing it out of proportion a little bit. It's the
23rd, man. You've got to make some news.
Well, yeah. If you look at China food inflation, you'll see the answer to the story. It's up to like near 20%. This is not about international economics or being a nice neighbor and rolling back tariffs for the U.S., et cetera. This is about domestic consumption, trying to boost their own consumption because they're definitely having issues with U.S. tariffs. And supply chain management is now the new mantra for 2020. Supply chains are going to change both for the U.S. companies and for China. And they're just trying to get ahead of this because they're going to lose business. They're going to lose opportunities as much as the U.S. is.
But then you get that, right? I'll do the glass half full. Okay, so you do that, and then you get South Korean exports might not be as bad as we thought. Then we get the PBOC saying, hey, we're going to be in there. We're going to maybe do another cut. Like, they're going to be constructive. I mean, I don't know. Is there a green shoot narrative around here? I want to be optimistic.
Central banks are going to support the issue, both PBOC and the Fed. If things start to waffle, they will come in at some point for sure. But South Korea, I wouldn't get too excited over one number.
Bumming me out, Yelena.
Well, certainly, we are not as optimistic as some people are. We still think that a lot needs to happen for economic growth globally to really take off. So uncertainties have not been removed. We still have to see the Brexit deal, right? We still have to see the phase one deal finalized. None of these things have been finalized yet. So, and we know a lot could go wrong. But, uncertainty is a big deal. Receding uncertainty could help economic growth next year, but it will take time for sentiment, to shake it off.
I can't disagree with any of that. I look at the end of the year and I say, wow, the market really has moved a lot this year. A year ago, we were sitting here. It was right before Christmas, right before the market made a low, and things looked kind of dire. And all of a sudden, we went from September, we might be getting into a global slowdown, to we're getting a turnaround and PMIs are turning around and it's all going to be okay. The market is certainly reflecting a lot of good news. And I think we have a lot of things that we have to do, but we have central banks still have our backs. You have a reasonable consumer, reasonable employment. It's a tough place to be, but if rates are going to continue to stay negative across a lot of the globe, then people end up being put into equity markets because they don't really have a lot of choices.
Okay, fine. Go ahead, Vince.
No, I was going to say we did get some good news just last week. Spending was up for the consumer, and the better part of that news was income was up. So that gives us an opportunity perhaps to carry it forward into the first quarter. But you certainly want to hope that those who forecasted the end of the world last December, who are now forecasting, nirvana, are not wrong once again, because this could be an unwind exactly opposite of what we saw last year going into next year.
It's not a straight line.
Before things could go right, though, next year, I think things could go a little bit wrong in the beginning of the year. So first of all, you have this Boeing impact. So we could see an impact of up to 1 percentage point, according to our estimates, just from Boeing halting their production. So what have been happening is that they've been adding to inventories, and that has been adding to economic growth. With them halting production, that will discontinue to happen. So we'll see a little bit of an impact there. And in addition to the usual residual seasonality issues with first quarter growth in the United States.
Which you've been warning about too, Vince, in terms of like you brought growth into the fourth quarter from the first quarter. But in my mind, though, won't investors just look through that? Be like, yeah, okay, the Boeing thing, but like it's going to replenish once they start production? Or is that like, am I still glass half full in a bad way?
Well, that could be up to 6 months away, and that's a long time to wait. We'll get durable good orders this morning, and we'll see how aircraft orders have impacted that. One of the things we'll also get next year, and we were just talking about this off camera, and I think it'll be second quarter, maybe even third quarter, we will get tax cut 2.0. It will be a middle-class tax cut. No one's going to vote against that in an election year. That stands to boost, again, consumer income, consumer spending. But I think the first 3 months of the year might be very, very challenging, as Yelena said. That's the first quarter that we'll see which way things go. Sarah says the central banks will have our back during that time, but how much they can really do to support that is another story.
Yeah, and I think that that's where you're going to start to see also after the end of this year where you've had such big performance. I think people are going to pause a little bit at the beginning of the year on the investment side and say, okay, where do I allocate? How do I allocate? And there may be some more quietness and not this continuous move up that we've seen since, for the last month or so. So I think the beginning of the year could be a little bit touch and go. And I think you're also going to have to see what companies say at the end of the year for what am I my expectations going into 2020, because you're going to get those year-end earnings when you start to get into January and February. And then you're going to start to see, okay, what are people trying to expect for this year?
Which is sort of what we heard from Vanguard's chief economist. I love this. He basically said to Bloomberg in an interview, financial markets run the risk of getting ahead of themselves. Yeah, okay. And then he said there's 50% odds of a correction in 2020. The more typical, exactly.
50%
for the
odds?
record, Vince was like, okay, but he says typically it's 30%. This time it could be 50, which is the whole like what's actually priced in, how much risk is being compensated for.
Well, I'm just laughing because of 50% odds that it won't be. It's kind of like
also true. That's why I couched it, and I was like, this is funny. But the idea.
I think if you want to look at that aspect of it, me as a former trader, it's like we're going to start the year as close to record highs, if not at record highs. So I never wanted to follow a guy who made more money than anybody else. It's like a real hurdle. So you show me what somebody's done in 2019 and you say, that was a great trader. He made a lot of money. Show me the guy in 2020 because he's starting out up here. And that is a really tough job to do. And I totally agree with you. There's going to be a lot of wait and see in the first quarter because you don't want to jump into the pool right at the top, and if it starts to sink, you start with a bad position. It's tough to dig out of.
But you also don't want to sell if you're going to get
totally
some
correct,
confirmation that things aren't terrible.
Which makes it really hard to do. It's like, when do you get in? When do you not get in? This is the first quarter is going to be a tricky time for traders and investors.
Yelena, you were nodding.
Well, I will be watching economic growth as an economist, and I think that we just need to get growth from anything we possibly can. Yes, personal income is accelerating a little bit, but overall consumer spending is slowing. So if we get a little bit from agriculture, a few tenths, we can do that. If we get a little bit from government spending, that would be awesome. And overall, we're expecting growth in the vicinity of 2%. So it will not be a disastrous year, but it will not be like a great year either, I think.
Which is what we're seeing, that you can still see some upside for the S&P, but maybe we're looking obviously not at double-digit gains, et cetera. So Sarah, in your opinion, and we'll get to more of this in a later segment, but what is actually priced in? Where is risk appropriately allocated? In what asset class?
That's a tough one too, because you're sitting right now with, so interest rates have gotten a little bit better. The curve, you've gotten a little bit more of a steepening in the curve, right? So that's going to help out the financial sector. It's going to help out some of those sectors that are sensitive to that. But I think that you still have, with the way global debt is priced, I think you are still pushing people out of debt and into equities. And the question is, what are those multiples looking like? And they're looking like they're higher because rates are lower, but that's sort of reinforced by central banks. So there's sort of a tautology going on with it's okay to pay more for stocks because rates are so low, when in fact rates are so low because banks have made them so low. So it's kind of difficult to say this is a really easy way to say this is the time to be putting more here because you need to do that. I think people are going to keep paying up for growth. I think we see that all over the place in different sectors where you have even some of the software names that have come down. You've still seen an enormous amount of multiple expansion across not even earnings multiples, but price to sales ratios and things like that. So we'll see what we can look for next year. But I think the beginning of the year is going to be a little bit quieter than the enthusiasm that we've come into at the end of this year.